Assalamualaikum and hi everyone, my name is Bibi Asmieyda binti YUSRI and in my video today I would like to explain about differences between Islamic finance and conventional finance in terms of value proposition, structure, operational mechanism and instrument offer. But first, let me explain to you what is Islamic finance and conventional finance. Islamic finance refers to how the business and individuals raise capital in accordance with Sharia or Islamic law. But for conventional finance, it is a transaction based on interest rate for saving surplus or deficit spending units to loan or borrow funds in financial market. So, we move to the first main section, which is value proposition. In general, value proposition can be defined as the product or service offered by the company that can make the business desirable. Besides, it also involves why the customer should purchase the product and how to value the product to customer. So, for conventional finance, it is more towards customer friendly, which means customer service that are meant to attract more customers with the ingenious objective of profit maximization. It is also bring more benefits to the doorsteps of their customer in a mutually beneficial manner through partnership modes of financing. In conventional finance, they also collect deposit and to give loan. It is important because income and pricing crucial when conventional finance introduce their problems. However, for value proposition in Islamic finance, it is deeply rooted in the Maqasid al-Sharia, historically include responsible investment and green business. It is based on the expert of law of Islamic finance to work with Sharia scholar. Besides, it involves global integration. For global integration, Islamic law does not reject foreign value as long as they do not contradict the fundamental of Islam. The last one is an all-embracing Sharia compliance. Next, for the second section is structure. The fundamental difference between Islamic banking and conventional banking lies in the structure of the establishment of the bank. For Islamic banking structure, even though income and price are important, it is also consideration about why the product or service is launched and the effect to the customer after they launch those things. Not all fees can be charged and not all fees can be used in Islamic banking. Based on the theory of sources and application of funds, Islamic bank is supposed to set up and should be a single flow between the deposits and the financing or investment use of funds. This means there is no discrete function. It is a single function where customer deposit or investment pool is used to fund financing portfolio or deploy into investment instrument from which returns is reorganized. Once the returns are determined, these returns are shared between the bank and the customer. For conventional banking structure, there are two main functions which are collect deposit and give loan. There are several modus operandi under conventional banking. It starts from shareholder give capital to the bank and bank receive customer deposit and invest the amount of deposit that customer deposit to the bank. After investment be made, interest received are distributed and customer will request for loan. In order to give loan to customer, bank borrow funds from interbank and lends the fund at an interest rate. Lastly, customer will pay to the bank for the interest plus principal. Okay, this is another example of key differences based on structure for Islamic bank and conventional bank. Okay, next one, we move to the operational mechanism. For the third section, which is operational mechanism, the operation of Islamic financial institution is the same society where conventional banks are operating. They perform all functions which are expected from a financial institution. Islamic finance provide all the service required in order to maintain the economy smoothly. However, the philosophy and operations are different. So, the main differences in operational mechanism for Islamic bank and conventional bank are deposit and financing and investment. So, for deposit, the differences is in terms of agreement of reward. For Islamic banking, they accept deposit through musyarakah and mudarabah where reward is variable. But in conventional finance, reward are fixed and predetermined. Under conventional banking, return is higher on long-term deposit and lower for short-term deposits. But for Islamic, higher weight for profit sharing is assigned to long-term deposit, being available to the bank for investing in long-term project, yielding superior returns and lower weight for short-term deposit, which cannot be invested in long-term project. So for the second differences under operational mechanism is financing and investment. Islamic and conventionals provide financing in their operation, but the differences that we can see is from financing agreement where for conventional bank, they offering loan to customer for specific purpose such as reward. However, in Islamic bank, interest is prohibited in their operation. That is why they cannot follow conventional. Thus, Islamic finance only charge profit on investment to avoid interest in offering their product. For conventional bank, they offer three types of loan to customer, which are short-term loan, overdraft, and long-term loans. Islamic banks cannot issue loans except interest-free loans, or also known as Qard al-Hasna, for any requirement. However, they can do business by providing the required asset to client. So this is another example of operational mechanism for conventional finance and Islamic finance. So the last one is for instrument offer. For the first one is based on deposit, or for Islamic finance known as mudarabah and qard. For deposit, in conventional finance, they accept deposit based on loan in all type of deposit, include term deposit, saving, and current account. It also provides interest for saving account and term deposit, but for current account, they offer free banking facilities. For Islamic bank, they offer deposit product based on two structure, which is mudarabah and qard, where mudarabah is a partnership agreement where customer will invest in various type of business under Islamic bank. Profit is shared based on profit sharing ratio and the losses is shared based on investment ratio. For the qard refer to current account where the risk of the funds lies with the bank and no added benefits are provided to the client solely based on this facility. However, clients may be allowed to avail those facilities which are offered across the board. Okay, for the second one is based on leasing or ijarah. In conventional finance, they call as a leasing, which is it is a contract between a lessor, bank, and lessee, customer, where the bank is the owner of the asset and the customer only utilize the asset based on the period agreed by both parties. The bank will not responsible if there are any losses happen in this contract, and the customer need to pay for the penalty if there are any late payment occur. For Islamic finance, in ijarah refer to in Islamic banking, they allow their client to use the asset based on fixed amount which is to be paid by the customer to the bank. For the ownership, it will divide it into two. For the first one is the bank still the owner of the asset, and or the owner of the asset will be transferred to the customer. All of these ownership have been written in the agreement. But if there are any late payment occurred in ijarah, the penalty will be considered as impermissible. So this is another example for instrument offered under conventional finance and Islamic finance. So in a conclusion, we can see that there are lots of differences between Islamic finance and conventional finance, especially for in terms of value proposition, structure, instrument offer, and operational mechanism. So I hope you learned something from my presentation, and that's all from me. Thank you.